Hi, my name is Yale Bach. I'm the owner and operator of YH&C Investments, a registered investment advisory firm based in Las Vegas, Nevada. Today's video is investing in today's market. We're talking about the financial services area, specifically banks. Banks take deposits from customers and they pay them a minimal amount, usually 0.01% to maybe 0.25% per year. You take that capital and then they use it to make loans or invest in securities. On the loan side, it could be a mortgage, it can be a business loan, a commercial loan for an industrial loan or construction or a big real estate project. So if I'm taking money and I'm giving you 0.01% or 0.05%, and then I take that money and I use it for a loan that pays me 5%, 6%, 7%, 8% per year, I'm making a spread. The other possibility is to take the deposit and invest it in a security like a treasury, which might pay 0.4% or, 4.0% or 5% based on treasury rates. So you're earning a spread. And that's how banks typically make money. They also have many other business lines. It may be asset management, it could be credit card processing, or it may be something like a prime brokerage or credit cards. So banks have a lot of business lines. The biggest risk for many banks is the highly leveraged business model that they use. So they make a lot of loans, which are considered assets, relative to the liabilities they have on the balance sheet. And if a small percentage of those assets go bad, it can cause problems in terms of liquidity for the bank, especially when you consider many banks are leveraged around 10 to 1. That's considered conservative. If you go higher in terms of 15 or 20 to 1, that's when banks start to have problems when the loans are poorly underwritten. Okay, so when Lehman failed, they had a leverage ratio of 50 to 1. Silicon Valley Bank was not that highly leveraged, but people started looking at their investment portfolio and they said, oh, that investment portfolio was underwater, and they got nervous and they decided to exit with their deposits, and that caused the bank run. So the biggest risk for banks is their highly leveraged business model and their funding in terms of their deposit base. The banking area is an interesting area to invest in, especially if you think about smaller community banks or specialized banks that operate in only one specific segment or two specific segments where they have areas of expertise. You might consider the banking area when you're looking for your next investment. If you have any questions, please call 702-350-0024 or email information@y-hc.com. Thank you for watching the video.